Hello, everybody. This is Brad Reed. I'm a real life trader, and I'm here reminding you to be good. And by good, I mean get out of debt, achieve your financial dreams, give generously to your community, and remember to take the mute off when you want to talk into your microphone. How's everybody doing? Thanks for being here. Today, we're going to talk about interest rates and how do they affect me. About once a month, it seems, the Fed comes out and they say they might change interest rates. They're going to change interest rates. No, they're not going to change interest rates. They're going to lower interest rates, even though they're already zero. But today, they came out and they made an announcement just 30 minutes ago. And today is December 16, 2015, for those of you watching the video. But that they are going to raise the interest rates by 1/4% because they think inflation is going to begin happening. And their goal is for inflation of percent. And over the decade or so, the inflation has roughly been sometimes a little bit negative, called deflation. But let's go talk about what all that means. By the way, if you have any questions, my email address is brad@reallifetrading.com, and the website, www.reallifetrading.com, is there, so you can go learn more stuff. The lawyers want me to remind you that this is for entertainment and education, and any investment, nothing that I say in this video or in this webinar can be construed as investment advice. If you seek individualized and personalized attention to your investments, to seek a competent and preferably licensed individual in your area. All right, that'll make those lawyers happy. If you're familiar with the financial fundamentals, we have covered those topics on the left. You can find that on our website at reallifetrading.com, or go to YouTube and do a search for real life trading and financial fundamentals. If you're new to real life trading, you'll notice on the right there that we have free stock reviews with trade setups. We have a ton of educational videos to learn how to trade stocks, whether you are a beginner or if you're a seasoned professional. There's probably something new in there that you haven't seen yet. And for all different types of investing styles, if you are a long-term investor or if you want to learn how to day trade options, it's all there and it's all free. Go to www.reallifetrading.com. There's also a ton of articles and videos like how to choose a financial advisor, how to retire on 3K. Those are some of our most popular ones. And announcing the first week in January 2016, we will have our trading rooms open for free. So this morning, Jeremy and I were both doing some day trading. And if you want to get into a webinar and you want to watch Jeremy and I day trade with our own real money, you can do that on that webinar. So there are the registration links. I will have those registration links in the description section of the YouTube. So if you're watching this on YouTube, there'll be a description box below the video, and I'll have those links in there. Today was one of our better days, and we did about 5.7 R. So if you had risked $100, you walked away with $570. If you risked $1,000, you walked away with $5,700 today. Now, I will admit again, one more time, that is better than we usually do. But we are on track for day trading to finish the year up 200% since we started in February. So at any rate, check it out. That'll be free the first week of January, but you must register. In this video, what the heck is the Federal Reserve and what do they do? How interest rates affect inflation, and how interest rates affect your investment, whether you invest in stocks, whether you have savings accounts, or in the bond market. Those are pretty much the three most popular categories. The Federal Reserve is the main bank for the United States, and the federal main bank lends money to the local bank and the banks that you see on the corner and the banks that you see on TV and on the internet. And then those banks in turn lend to you, and then they lend to you with home mortgages, car loans, some of them student loans, credit cards, personal loans. All those different types of loans come from these local banks, but they get their money from the Fed bank. And a lot of the times they get their rules on who they can loan to and under what conditions they can loan to from the Fed. Now, the federal, we call them the Fed. Janet Yellen is the chairman of the board. And there's a board, I think it's made up of 7 members, but they set interest rates. And their purpose is to promote GDP, gross domestic growth, with minimal inflation. So GDP is also kind of like how much the United States of America produces, whether it's goods, services, whatever. The GDP is kind of like our nation's output. And they want, the main bank helps the United States of America economy grow as measured by GDP. And if it grows too fast, inflation gets crazy, so it's growth but with minimal inflation. And then the reason they want to do this is to support high employment, minimal inflation, and moderate interest rates. The main tool that they use is setting interest rates. And they also set rules on the cash reserves. So as I said previously, the banks can loan out money. Well, in order for them to loan money, they have to receive money. Now, in order for them to make good on anyone saying, hey, I want to take my savings out, they need to have some cash in reserve. And the federal bank can control how much cash they have to have in reserve. The lower the cash reserves, the more money the banks can lend out. The higher the cash reserves, the less the banks can lend out. And again, interest rates, the lower the Fed interest rate, then the lower the interest rate that the banks lend to us. So as far as your mortgage, your car loan, your credit card, whatever loans that you're taking, those rates are dependent upon the federal rate from United States Bank. Now, interest is basically the cost of borrowing money. So when you go and you borrow money to buy a house, you have to pay a mortgage, right? And there's an interest on that mortgage of 3, 4, 5%. That's the cost of borrowing the money. If you get a car, if you buy a car on a loan, financial fundamentals, we advise not doing that. But if you do have a car payment, there's an interest rate on that car payment because that is that's how the banks make money. They loan you the money, and then over time you pay it back, or you pay back more than you borrow. Same thing with the credit cards. You have to pay back more than you borrow. That's called interest, and that's the cost of borrowing money. Now, the interest rates on the credit cards, on the mortgages, on the car loans, on the student loans, on the whatever you're taking loans at, are usually the Fed rate plus the margin. That depends on the risk. And that risk has to do with your credit score, how good you have been at borrowing large sums of money and paying it back. It also has to do with the time to repay. The less time usually means that you're in better financial condition. It also means there's less chance for catastrophic events, high inflation, or anything else to mess up the terms for the lender. So usually the longer the term, the higher the interest rates. Also, is there any equity in the things that you... The reason house loans are generally low is because there's usually a lot of equity in the house. If you can't pay the loan, then they can take the house and sell it, and the bank still comes out ahead. Whereas a credit card usually has very high interest rates, because if you go and you buy dinner with your credit card and then you can't pay the credit card company back, they can't usually take the dinner that you ate and resell it and get any of their money back. So the credit cards have high interest because whatever you buy, they can't really force you to give back. All right, so that's just a little bit about interest rates. Now, here's the magic. As interest rates go down and or the cash reserves go down, borrowing increases. So would you rather get a loan at 10% or a loan at 2%? Obviously 2%. So as the interest rates go down, people get more excited to borrow money, and that leads to more spending. As interest rates go up and or the cash reserves go up, borrowing decreases, which leads to less spending. Now, as I previously said, the goals of the Fed are to grow GDP while minimizing inflation, but realize that these folks have very strong political ties. They are appointed by the people, the elected officials. We are coming up into an election year, and therefore that might motivate or influence the policy decision a little bit. And then kind of on the opposite side of that, an interesting factoid that was presented to me was that at the end of the last several 8-year presidents, we've had a very large market correction. So at the end of Reagan's term, there was 1987. In October, there was about a 20% market correction that they called a crash. At the end of Bush #1 in 2000, there was a large market correction. And then, of course, a lot of people are still feeling the effects of Bush II's the market correction or crash at the end of his term. Are these Feds about a market correction at the end of Obama's term? But not really sure what that means, but my point is that there are political influences and political ties to some of these decisions. And I found it interesting that today they said the reason they increased rates is because employment is going great, which some of the numbers I've seen make it look not so great. But they say employment is doing well. The economy is going to rebound. They didn't say it has rebounded yet. They said inflation will begin to rise. They said it hasn't risen yet, but they are raising interest rates and plan to raise interest rates more in the future. So based on what kind of this says is that borrowing is now going to decrease and there's going to be less spending. So we'll talk about what that the effects of that are. First, I want to talk about inflation. On the left there's a picture of the cost of living in the 1970s. A new house was about 20 grand. The average income was less than 10 grand a year. A new car cost about 3 grand, and so on. Obviously, that's not the way it is now. Things are a lot higher now. And then you see the McDonald's menu. I don't know what year that is, but obviously it wasn't anytime recent because things are a whole lot more expensive now. But this is because of inflation. Inflation is basically the price of living increase. And year over year, they measure the consumer price index called the CPI. And that has to do with the price of housing, the price of shelter, the price of transportation, the price of food, the price of clothing, the price of all this stuff going into the price of. Now, if the cost of living increases year over year, or the CPI, the consumer price index, we call that inflation. If it decreases, we call that deflation. And again, the Fed's goal is 2% inflation because they believe that will allow for rapid growth without too high of inflation. Now, good inflation happens when the economy is doing well, lots of people are making money, and when lots of people are making money, that means they're buying lots of stuff. And if the sellers cannot meet the quantity demanded by all the buyers, then they tend to increase the price, and that lowers the quantity demanded. So that's good if the economy really is doing well. If people are getting jobs and people are making money, then they'll go out and they'll start buying stuff, and that will lead to a rise in inflation. Now, this needs to be regulated because there are some places where inflation goes out of control. And I remember back in business school reading stories about places where inflation was high that the grocery stores get cleaned out every single day because the cost of food would double overnight because of inflation. So let's say you get your paycheck and your paycheck is $1,000. Well, you can buy $1,000 worth of groceries, or let's say you get paid at the end of the day and your paycheck is $400. And with that $400, you can go buy some groceries. But if you wait till the next day, the price of groceries is going to double because of inflation. So if inflation runs rampant, if it runs out of control, then society tends to kind of break down as everyone goes crazy buying and it just gets a little bit nuts. So inflation needs to be kept under control. Good inflation has when lots of people are successful, they have money, and they want to go buy things. Bad inflation happens when the business costs increase and require sellers to increase prices. So if taxes go up, or if the cost of labor goes up, or if the cost of materials goes up, or if the cost of transporting your goods to market goes up, or if any of these costs of businesses go up, then the businesses have to pass on that cost and increase the prices. And again, when they do that, the cost of living goes up, inflation goes up, and that is what I call bad inflation. All right, so how does this affect the stock market? As interest rates go up, as interest rates go down and or cash reserves go down, more money goes into the market, right? Stock market tends to have a more bullish edge. This was the reason that they decreased interest rates back in 2007, 2008, just about a decade ago, was because they wanted to prop up the stock market. So businesses can borrow at lower rates so they can grow their business, they can buy new factories, they can open new stores, they can invest in new product lines. Many businesses, they don't own their inventory. They take a loan out on their inventory. So for instance, if you go to the grocery store, you would assume that the store has already bought the macaroni and cheese that you're about to buy, but in fact, they took out a loan for that macaroni and cheese. So when you buy it, then month over month, the store is able to pay back their loan and get a new loan and buy more inventory. So this is one of the big dangers of the way our economy is, because if a grocery store cannot pay back their loan one month, all of a sudden they can't get a loan the second month to put food back on the shelf, and things can get bad. But at any rate, many businesses have loans. So if the interest rate goes down on those loans, then their cost of business gets lower and they become more successful. They have more money, they have more profit. And then for those of you like you and me that borrow money from the banks for houses, let's see, I don't borrow money for credit cards. I paid off my student loans or cars, and I suggest you do that. But most people, they do borrow for those things, and when the interest rates go down, they can spend more. So as interest rates go down, it produces more spending, and that tends to prop up the market and can drive the stock market upwards. As interest rates go down, sorry, I got that reversed. As interest rates go down, there becomes more spending, more borrowing, more money into the market, so the stock market tends to go up. Now, as interest rates go up, which is what happened today, the stock market tends to have a less bullish edge. I'm not going to say it's more bearish, because they would rarely increase interest rates if the stock market is going down. So I'm just going to say it's going to be less bullish when they increase the interest rates. Now, borrowing decreases, and that leads to slower growth. Businesses that operate with debt, they're going to have a higher cost of business, so their profits are going to go down. And when businesses slow down, right, they hire fewer people, they make fewer profits, they pay out less money. So again, this will slow down the economy just a little bit. And buyers like you and me that use debt for houses, and maybe people that use credit cards or car loans or furniture loans or student loans or whatever that, they tend to borrow less and therefore spend less. Now, I talk a lot about the stock market has a less bullish edge or more bullish edge. Sometimes this works in reverse if investors, and especially market analysts, these people that write papers, that usually they don't invest, but they write lots of papers about investing. If they see this market, this Fed interest rate increase as a symbol that the economy is getting better, that might, in the short term, drive the market upwards. But overall, an increase in interest rates, as we saw today, is to kind of slow everything down, back everything off, so that inflation doesn't get going too crazy. And again, I'm a little bit confused as to why they did it when inflation has not yet increased to their goal of 2%. Savings account. So banks offer you an interest rate to entice you to loan them money. So previously I mentioned that banks borrow money from the Fed. Well, they can also borrow money from you. And they say, hey, they don't say, hey, I'm going to borrow money from you. They say, hey, would you like to open a savings account and put a bunch of money into this savings account? Because when you do that, they then in turn take that money and go and lend it to someone else. And they call it savings accounts, CD, certificate of deposits, and sometimes the bank will have little money market funds. Now, in the last, how long has it been? 10 years, maybe? 12, maybe 15 years? Savings accounts and CDs have been just about zero. But I can just see, I'm 41, and I can just barely remember when savings accounts were paying 2 and 3% a year, CDs, which certificate of deposits, were paying 4, 5, and 6%, and the money market funds were paying 3 and 4%. So it was pretty easy to keep up with inflation with some of those investments. And the important thing here is that lots of senior citizens tend to invest in these products. So when the interest rates have gone down like they have for so long, the senior citizens didn't have a way to grow their money. And that was and has been very, very painful for senior citizens. So the increase in interest rate will bring back savings accounts, CDs, and money market funds, which are things senior citizens like to keep their money in. Okay, so as interest rates go down, and our cash reserves goes down, the saving interest rates go down. So people tend to save less and spend more, right? If I can have a savings account where I get 0% return for keeping my money there, why would I keep it there? Let's go spend it. But if I have a savings account that's paying 4%, or maybe a certificate of deposit that says, hey, if you leave your money here for at least 3 years, we'll be paying you 6%. Well, then that might entice me to spend less and keep my money in savings. As interest rates go up, which is what happened today, the interest rate on your savings account will go up. So people will tend to save more. You might see certificate of deposits go up more. So as the savings go up, you'll start to see more bank commercials that talk about interest rates on their accounts. Right now, all the bank commercials are talking about their low fees and their low transaction fees and the costs and their high service, because there is no interest rate in the savings account. Okay, now this is the one that's near and dear to my heart, because another big part of senior citizens' portfolio are bonds. And then I know a lot of, lately, I'm going to say in the last 5 or 10 years, a new investment vehicle has opened up, and it's one of those things where you pick the date at which you retire, and then they manage the fund according to a balance of stocks, bonds, and cash. And then as you get closer and closer to retirement, the percentage of bonds goes up because they think, hey, bonds are more stable. So let's first talk about what a bond is, and then we'll talk about how it changes with interest rates. If a business or municipality, because you can get bonds from a government, if they don't, or they don't want to, or they can't borrow from a bank, they'll go out to the public like you and me, and they'll sell bonds. So you and I can buy the bonds from these businesses or governments, and basically they usually are in amounts of $1,000. So usually you can buy a bond for $1,000, and then every year, or however often they want to pay, they'll give you an interest payment. And of course that interest payment is just like all the others, it's the Fed rate plus some certain margin. Generally bonds pay higher than CDs. They usually pay more than savings account in order to get people out of those vehicles and into the bond. And then at the end of the term, whether that's 10, 20, or 30 years, the original amount is paid back. And I'm sure you can find bonds that expire in just about any number of years, maybe even months. And you can, most of them pay annually, but I'm sure you can find some that pay quarterly or monthly. The bonds are bought and sold just like stocks. So you can go out and buy new bonds, or you can buy existing bonds. And bonds are also included in bond funds. You can get a mutual fund that deals with bonds, or you can get ETFs, exchange traded funds, that are kind of like mutual funds except they're traded on the stock market, that also invest in bonds. Now, that's a lot of explaining, but here it comes. As interest rates go down, okay, the interest of the new bonds goes down. So if Coca-Cola was going to issue a bond so that they could build a new plant, and they want to issue a bond tomorrow, that cost, the interest rate on that bond is going to be higher than if they did it today. So as the interest rates go down, the return that people get on those bonds goes down. And this is, I actually had a neighbor when I lived in Kansas City that was getting a little bit upset because he had purchased a lot of bonds for his retirement portfolio, and as the interest rates went down, those bonds were doing great. And in a little bit, well, let's see, let me hit this button. The value of existing bonds with higher interest goes up, because what would you rather own? Would you rather own a bond that pays 6% interest, like you could easily find in 2003, 2004, 2005? Or would you rather have a bond that pays 1 or 2%, which you could find in 2010, 2011, 2012? So again, the older bonds were more valuable. He was getting very upset because the term on his bonds were coming due, and the new bonds that he was forced to buy were at a much, much lower interest rate, and they didn't pay him as much to hold on to those bonds. So again, senior citizens can get very, very badly hurt with low interest rates because their investment vehicles don't pay as well. Now, the new problem that's going to come out, and again, this is going to affect senior citizens and anyone else who has bonds or bond funds. As interest rates go up, the interest of new bonds goes up, and the value of existing bonds goes down. Because nobody wants the yesterday that pays 1 or 2%. They want the bond issued today that pays 2 or 3%. And as these interest rates continue to go up, as the Fed says that they will continue to raise interest rates on a slow and gradual level over the next several quarters or years or however long. But as those interest rates go up, the value of the current existing bonds will go down because no one wants bonds. They want the bonds that pay a higher interest. So again, if you are a senior citizen, or if you know senior citizens, or if you know anyone that has a large amount of bonds, now that these interest rates are starting to go up, you need to be very, very careful of the value of the bonds if that is what you're interested in. So if you are holding a bond because you want to collect the interest payment, no problems. That's very likely to happen, right? They're still going to pay. But if you were intending to resell that bond, or if you have a mutual fund or ETF that the NAV, the net asset value, the price of a fund is determined based on the value of the existing bonds, that if it has not gotten demolished already, it is going to get crushed. Because as the interest rates go up, the value of the existing bonds is going to go down severely. And let's just say I hope I'm wrong, because I know there's going to be a lot of senior citizens with bonds. All right, so in summary, as interest rates go up, the stock market bearish edge increases. Bearish edge, so as interest rates go up, the stock market has less fuel to go up. It pays more, so a lot of people are going to be putting more into savings. And new bonds pay more, old bonds decrease in value. Right, and because of that, that is the result, spending going down, economy growth and inflation going down, and business costs going up. Now, when interest rates go down, the stock market bullish edge increases. It pays less to save, so people tend to spend more. And the new bonds pay less and the old bonds increase in value because everyone wants the old bonds, no one wants the new bonds. So spending goes up, economy growth and inflation goes up, and business costs go down. So what did you do? You need to update your protection, whether you have stops, whether you have puts, etc. When the Fed talks about interest rates, you need to act appropriately with any bonds and bond funds that you may own. And if you don't know how to do any of this stuff, guys, go to Real Life Trading. Okay, we'll teach you how to trade. You need to learn how to trade. You need to learn how to act appropriately with your investments. Even if you choose not to do it, you need to know if your financial advisor is treating you well. Because I guarantee you, no one cares more about your retirement and your investments than you do. And realize that the financial advisors and the stockbrokers out there, they get paid whether you win or lose. Okay, they get paid whether you win or lose. So the only person that really cares if you win with your money is you. So learn how to trade. Go to www.reallifetrading.com. It's free. And I've said it in the financial fundamentals videos. Most people spend more time planning a vacation in 1 year than they do planning their retirement in their entire lifetime. Don't let that be you. Don't let these Fed talks, interest rates go affect your retirement in a negative way. Once again, the live trading rooms are going to be free in January 4th to the January 8th, I should say. If you're interested in checking it out, there's a day trading room and a swing trading room. If you want to see both, you have to register for both. And I'll have these links in the description box below. But once again, the Fed has increased interest rates. This will make it a little bit harder for businesses to grow and for people to spend money. In the long term, that is expected to slow down the economy, slow down the stock market. There is a chance that investors will say, hey, this means the economy is coming around, the economy is growing again, or else the Feds would not have increased the interest rates. So we might get a boost in the stock market. Of course, that's what I'm hoping for, but we'll see what happens. Let's see, I think there's my ugly mug and my address, brad@reallifetrading.com. Email me if you have any questions, comments, thoughts, opposing views. Check us out at reallifetrading.com. And with that, I'll bid you adieu and say thanks for watching this video. Thanks for attending this webinar. Trade on logic, not on hope. Have a good one, everyone.